Welcome to the What to Watch video update. This is the last video that I do over the weekend where I look at the charts, both positive and negative, and the ones that I'm really focusing on right now, I organize them into those things that are looking pretty good, those things that are not looking very good. And as always, there are some negative things that you can put on the positive side, and there's some positive things you can put on the negative side. So I try to go through these charts and point out the good and the bad. As we asked the question this week, will Santa be a no-show? Santa Claus rally hasn't really kicked into gear. We still have Monday and Tuesday session, full days of trading available to see if we can go up from here. And then that'll carry over into Thursday and Friday, the first two trading days of the following year, 2025. That's considered to be the Santa Claus rally period. And we're not doing all that great to this point. We're not doing terrible either. We were doing pretty good this week, and then we had kind of a significant down day on Friday that we were seeing some improvements under the surface, and things were looking a little bit better, but a lot of that got pushed back in Friday's session. Okay, before I get into that, starting in 2025, will be the lockdown version of the SPX investing program. Still from now for the next couple of days, if you want to check this out, feel free. It's wide open for the time being. There are additional videos that I post there. You also get immediate access to the videos as they are available. And there's a link that will take you to the website. There's a link that'll take you to a video. Feel free to check that out. If you have any questions, you can email me at this address. Also, even though this is one of the weekly videos that I do, and it's one that is pretty important because it just focuses on what I'm really looking at, that's called the What to Watch video. It's just one of the outside videos that I do. These charts that I'll go through here, I will be updating them and talking about the things I'm talking about here on a day by day basis in the daily video. And that's really where I do my analysis and commentary. Okay, let's go through and look at some of the positive things. When we look under the surface, this has been positive for a while now. We still see on an intraday basis here that large cap growth, the blue line is outperforming large cap value, where it's been going down with the red line as the blue line's been going up. Now, it took a bit of a hit this past week, but it's still outperforming. And that could be, again, as I said, under the surface strength that could come into the market. It's not really making itself known as far as price action, but it is under the surface, and that's where we like to look at things. We're also looking pretty good here. If you go back to the end of November and we look at the intraday chart of growth versus value for the S&P, it's been in a pretty solid uptrend. It's leveled off right now. If this can continue to go up, that would be more positive. If it starts to go down, yes, that would turn it more negative. Then looking at the end of day chart of growth versus value, even though we pulled back in Friday's session, we're still in an uptrend and we're still looking pretty good here. And we want growth to outperform value. Also, we're still looking pretty good here when we compare a growth versus a value ETF. That's looking pretty strong. Even with the small caps, you can see the index trailing off, going down, at best going sideways lately. There's still some underlying strength in the small cap index with the growth and value ratio. It's in an uptrend. We just are not seeing it in any kind of upward thrust, at least yet. And we're seeing pretty much that same thing with mid cap growth to value. Looking positive here, not seeing it in the index. We look at different growth to value ratios. The Qs to the S&P still above the moving average. Discretionary, which has been a stronger area going back to last October, the strongest sector has been discretionary compared to the S&P, still looking good. We're still looking good when we compare large cap growth to large cap value. We're looking good with the large caps. Mid caps coming down. We're actually seeing a little bit of weakness here with the small caps. That's a little bit of a concern. We'll see if that can turn and go back up. The one positive thing is all these moving averages continue to go up. We're also looking good with discretionary to staples, and that ratio is still looking pretty solid. That's another under the surface area that could show some strength. We just need to see it come through with price. Large cap growth, even though it's been coming down, it's still well above the moving averages here, the 50, the 100, and the 200. So that's holding up, and that's really what's been doing better in the market. A lot of folks are anticipating the small caps to really take off right now. It's going to be really hard to do that as interest rates continue to go up because companies, small cap stocks, you have to borrow a lot. And the more they pay for interest, the less that bleeds through into earnings. We're also looking pretty good here when we do a ratio between large caps and small caps. It took a hit a bit this past week, but it still has been going up. We've been chopping around a lot lately. If this can continue to go up, that would be more positive for the S&P. And we're below 20. The reason why I have this on the positive side is the VIX had really gone up here, both on the closing basis and the bar chart. And we're still slightly above the moving averages here down on the bar chart. But on a closing basis, we're below the moving averages here. And the fact it did go up in Friday's session because we had a down day. But overall, this has been coming down. And when we're down at this lower level, we closed at 15.95. It's not really low for the VIX, but it's not as high as it had been. We're in this kind of light green area where we do see positive annualized returns. Also, the momentum of the VIX could be shifting from up to down as measured by the MACD. That would be more positive for stocks. And we look at a risk on to risk off ratio. When this is going up, folks are more risk on, and that tends to be more positive. If this can keep going up, that would even show more strength. If this levels off or goes down, that would show a lack of conviction. This is also positive, the Swenlin trading oscillator. It actually started to turn up and has been looking pretty solid for the last number of trading days. We've crossed above zero based on price and volume, and sometimes this leads price. But sometimes we get false signals from this chart as well. So we want to be leery of that. And we're positive with the parabolic SAR. We did, with the nice little up move, we did switch back and we have dots underneath. Now I'll show you later on, the weekly chart is still negative. So the bigger picture hasn't switched back to positive yet. But here on the daily chart, we are positive. And we're still above the 50-period simple and exponential moving averages here. That actually acted as support in Friday's session, and we were able to bounce up off of that and close off of that. So far, that support level is holding. And so we're negative in the short term now because we dropped below the 20-period moving averages, but we're above the 50-period moving averages, so we're still positive in the intermediate term. And then the 100 and 200-period moving averages continue to go up. So the more somewhat intermediate to long term is measured by the 100, and then the long-term trend measured by the 200, those are still positive. And we're looking positive here. This is a smart money indicator, which takes both price and volume into account. It's called the Chaikin oscillator. And even when we were coming down in Friday's session, this still continues to go up. It's above the moving average and advancing, and it's also above zero. So this smart money indicator, there are three that I look at. This is the most positive looking one right now. This is positive because we're at the top end of this trend channel, but this could also be negative in that we're bumping into the top of this trend channel, and we can go above it like we did in 2021, but so far we've been having trouble with the S&P getting above that level and staying above it. So there's a positive side and a negative side to this chart. And we're still seeing where the S&P 500, which is a weighted index, is outperforming the equal weighted version. Now that's good if you're in the S&P because that means the mega caps and the big companies are really doing well, and we want the S&P 500 to move. If you are interested in the equal weight version or the broader part of the index, this is a little discouraging to you. This just means that the big stocks are coming back in and taking over and have been showing leadership. And we're also seeing that here where we look at the equal weight compared to the S&P. When this is going down, that means the equal weight is underperforming. To say it another way, the S&P is outperforming the equal weight, which is the reverse of the previous chart. We're still positive here with the Nasdaq. It's hard to see because we have the new pivot points coming in. And I really like pivot points for that reason. They're on the chart and they set their level for the whole month even before we get there. And so these are very important and they can often be very significant. I update intraday versions for the S&P 500 every day on the YouTube community tab. And there, I also update a daily chart that applies to the whole month. These are the pivot points for the NASDAQ, and those tend to be pretty important for the NASDAQ. So we'll be watching these. We're still above the 50-day moving average and not too far from the all-time high. So the NASDAQ has been holding up fairly well. NASDAQ 100, same thing with the pivot points, also holding up here. Now, one thing, this isn't a good chart to do that. I'll try to point this out. Like on the Qs, and we're seeing this with the S&P as well, where we came down and then we came back up. And now if we go back down and set a lower low than what we set here, this is when the Fed came out and freaked out the markets. That's going to turn things a little bit more negative. This would make a lower low here with a after a lower high. So we want to watch this price pattern here. Now, if we can get back and stay above the 20 period moving average, this is a little more positive. We're still positive here and go up with the Qs and then see the same thing with the S&P chart. That would be a lot more positive. If this breaks down, that's going to turn things more negative technically. The Wilshire's right a little bit above its 50-day moving average, a broad market measure here that support is still holding. We're also a little bit above the 50-day moving average with the total US stock ETF. That intermediate term support is holding. The financial sector, after showing some weakness, is back up to its 50-day moving average. We want the financial sector to hold up and to do well. That helps the overall market. The FANG index, one of the stronger indexes. This is like the mega caps, the Facebook, Apple, Amazon, Netflix, Google, Nvidia. We want this to do well. When this does well, the S&P does well. Now, we did break out last summer and then we fell back and then lagged through the end of summer into fall. And the S&P was still doing well. That's because the rest of the stocks in the S&P were doing better and the mega caps were kind of falling behind a little bit. Coming up into December, the mega caps have really taken over leadership again. That's why we watch these. I show charts of the mega cap stocks in every daily video. And so we want to keep an eye on this index. It's still looking positive here, but we're still having a little bit of trouble with the FANG index just getting back above this short-term trend line. It would be more positive if we could get back above that. If we don't, and then we start to come down, this may be acting as overhead resistance. We look at a ratio from the staple sector to the tech sector. When this is going down, that's more positive for the market, and that's what it's doing. Also, the market is still anticipating a soft landing, meaning that we will not go into a recession. We took a little bit of a hit here with this ratio, but we're still at the top end of the rainbow, and that means a soft landing, no recession. And we look at the broad market and look at short-term bonds, 1 to 3 year. We're coming into the top end of the rainbow, but still holding up for the most part. Also, another broad market measure looking at 3 to 7 year bonds, still at the top end of the rainbow. The tech sector to 3 to 7 year bonds, still a little bit above the rainbow. So these ratios are holding up, and we're holding up longer term with the weekly chart of the NASDAQ 100. We're above this trend line going back to 2009. The ratio of NASDAQ 100 growth mega caps versus Dow more value stocks, even though Nvidia is now in the Dow, this ratio continues to go up, and that's more positive. Also looking at the QQQs, the NASDAQ 100 to the small caps, this ratio is also going up. When we get concerned is if we really see this ratio start to go down, but it's going up right now. The Qs, the 3 to 7 year bonds, coming down a little bit in Friday's session, but still above the rainbow and looking pretty positive. Now we go over to the negative side, and we're negative. We were almost positive after Thursday. The green line and the red line were almost on top of each other. And then with the downward move that we saw in Friday's session, that bumped the red line up and the green line down. Now we're not trending right now because the ADX, that's the dark black line here, it's below 20. That's a static level that I use to determine whether we're trending or not trending. Then I also plot a moving average on top of that. That's more dynamic. It changes as the ADX changes. When we're below the moving average, that also suggests a weakening trend. So we're in a non-trending, weakening trend environment that is now negative because the red line's above the green line. And we see pretty much that same thing here with the ADX in the intermediate term, going up with the red line, down with the green line, below 20 and below the moving average. And we're below average with volume, which is not a surprise. This is a holiday week, and we still have another holiday week yet to go. So that is negative in that we like to see healthy volume, but it's also realistic because people take vacations during this time of year. But it also makes the market vulnerable. It can make it vulnerable to the downside. It can also make it vulnerable to the upside. If a big player comes in and does a lot of selling or a lot of buying, that can really have an impact on price movement. We're also negative, but showing some improvement here when we look at sentiment. We're well below 50. We came down and dropped below 25. That's negative. The fact that this is on the negative side is that we really didn't do much over the last couple of days and we're below 50. Now, if this can continue to go up, the context of this would turn more positive. And if we cross above 50, it would turn more positive and be better for the market to go higher. Seeing some attempts at improving here. This is again looking under the surface at the S&P. We didn't really see any new highs or new lows in Friday's session. We're trying to turn back up with the 5-day, but we're still going down with the 10-day moving average. We need to see the green start to pop up again and show more new highs to be more positive. If we see more red, that means more new lows, and that would be more negative. And we were seeing some improvement here with the advanced decline line based on price and volume. We were starting to bounce up, but then it turned back down in Friday's session. And because the overall context is that we've been declining, that's why it's on the negative side. But when we saw these big green up thrusts here, both for price and volume, that's positive. Now we need to see more follow through with that. And we were almost turning positive with our advanced decline ratio. In the short term, that's the blue line. It came right up here and then went down in Friday's session. We're also going back down with the 39-day. That's more intermediate term. And we're still negative here. We had been improving with the advanced decline line based on price. It almost went back positive. Now it's back to negative. We had gone slightly positive based on volume. Now we're dropping back down to negative. And you could look at this a couple of different ways. If you look at this really close, you might see that we're just barely above the moving average, or you could say we're on top of the moving average, but you can see we're coming down a little bit with this boom indicator. I'm treating this more as negative until we see a good solid up day and this really turns and goes back up. This is the second smart money indicator. Now, the first one was the Chaikin oscillator, and it's positive. This one, I would say, is probably more neutral right now with a slight lean towards the negative side because of Friday's downward move. This is also trying to improve with the Chaikin money flow. This is another smart money indicator. The histogram, the red lines here, they're trying to go up, but we're still going down with the moving average and at best flattening out here. So this is improving, but still negative since we're below zero. We want to see this turn green and go up, and we want to see the red line turn and go up as well to turn positive here. And we're still negative with the vortex. We were coming down with the red line. We were coming up with the green line, but then in Friday's session, we're going back up with the red line and down with the green line again. The condition of the short-term trend, we're more vulnerable now because we're dropping below this blue line and green line. And the longer we stay below this, the more these lines will roll over. It will turn back positive if we can get back above these lines, close above it, and stay above it, and then see the lines continue to go back up. We're also looking vulnerable with the intermediate term. Now, we're still positive when we measure this using moving averages. These are double and triple exponential moving averages, also based on 50 periods. We're still below the red line and the blue line here. It would be more positive if we could get above these lines. As long as we don't, that puts the intermediate term trend at a more vulnerable state. And here's the 20 period moving average where we're down below that now. So the short term trend is negative. Here's a short term rainbow where we fell all the way down below the rainbow. That was the big down day. We were able to come back up and peek our head out of the top of the rainbow. Now we're coming back down into the rainbow. And these lines are a series of moving averages going from 10 periods up to 50. And I use this to gauge the short term trend. Looking more negative here, when we look at the cumulative advanced decline line for the S&P based on price, We had been coming down. We were starting to bounce and then came down on Friday, both based on price and volume. So we want to see more follow through here to turn more positive again. And this is a 20 period simple moving average of the open high low close for the S&P. Sometimes these lines act as overhead resistance, and that's kind of what we're seeing right now. We want to be able to get above this to turn more positive. This is what I call a mini rainbow. If we continue to fall down from here, these lines will start to roll over and that will turn more negative. And we're negative here. This is longer term, more intermediate to even a little bit long term, where we look at a 10-day average of the highs and lows for the S&P, where we spent most of 2024 way up above this green line. Now we're dropping below 50, which turns it negative, and we're still continuing to decline here. And we look at those stocks inside the S&P above their 20 period moving averages, we had come down to an extreme negative reading, which quite often can mean we're oversold in the short term, and it could still mean that. And we were starting to bounce back up, but then in Friday's session, we started to come back down. And then what goes in conjunction with that is a 20 period moving average study where we had come down and dropped below 10. And now in a fairly quick period of time, we want to come back above 70. But we want to go all the way up to 70 because look what happened in October of 2023. We went below 10, started to go back up. Everything was looking really good, but we never made it back up to 70. And you can see we hit a low here, started to go back up, and then we set an even lower low here based on price. Freaked out a lot of people. It was a They got whipsawed in here, but then they got taken out. So then what did the market do after that? We saw a positive divergence here where this indicator made a higher low, where we made a lower low based on price, and then we saw a nice little upthrust out of that. We'll be watching this chart, and I'm watching it day after day, going through it in the daily video to see what ends up developing with this chart. We look at the stocks above their 50 period simple moving average inside the S&P. We're negative since we're below 50. We came down to a really extreme reading. We were improving. Now we're starting to fall back. The same thing with the 100 period moving average study. Below 50, improving, now falling. We're still positive with the 200-day moving average study since we're above 50. But we saw this take a hit. It was improving. Now it's falling back. And this is a new chart, and I'm going to be showing this in the daily video too. This is not quite a, well, it is a pretty good comparison. And we try to take the advanced decline line and then turn it into an oscillator, where this chart takes the advancing issues on the S&P, subtracts the declining issues, and then I plot a 10 period moving average over top of that. So the actual results are turned invisible. What you see here is the 10-day simple moving average. And this works similar to an oscillator. When we get to a really negative reading, sometimes that precedes what happens with price, and then this starts to improve before that. And then when we're really going up, sometimes this will get a really high reading, and then we may not turn and go the other way, but we can certainly slow down from there. And then other times when we get high readings or low readings, like right at the end of October, and then we went into the election, that produced a nice little signal here. Well, we were getting a really extreme negative reading, and we are improving. Now, we pulled back on Friday, but if this can continue to go up, that quite often can mark some kind of significant change. Or if we continue to fall, it could also mark a continuation of the decline. Parabolic SAR, still with the weekly chart, we're positive on the daily chart. But here on the weekly chart, we still have the dots on top. That's negative. And the cumulative advanced decline line for the NYSE, we're dropping below the moving average, and we're still seeing some weakness here with our regular NYSE advanced decline line, as well as this other NYSE advanced decline line. And we're still seeing weakness with the common stock on the NYSE based on price and volume after we had been seeing some signs of improvement. We're still looking vulnerable here with the advanced decline line studies. We're below the moving average with all the different indexes. We were starting to turn up, but then we came back down on Friday. We were turning positive with the McClellan oscillator for the S&P. We crossed back above zero. Friday, we came back down below zero. So we were starting to turn up based on price and volume, but now that looks to be in jeopardy. We have to see more positive price action. And we never did turn positive with the NYSE McClellan oscillator. We were improving, but we never got up to zero, and now we're going back down. So we're continuing to decline based on price. But if you notice here, it's really hard to see. We might be trying to improve here based on volume. We'll have to just see how this plays out. And on a momentum basis, we're still negative. This is a daily chart, and I have two short-term oscillators, three intermediate-term oscillators, and two long-term oscillators. They're trying to improve here, but they're still negative. And the bullish percent index, which measures the point and figure buy or sell signals inside of the S&P, we're below 50. We blipped up just a little bit on Friday, but we're not even back up to the moving average yet. We need to see this go back up, get above the moving average. That would turn it positive, and then it would become even more positive if we cross back above 50. It's not happening yet. And we're also possibly seeing a little bit of an improvement here, but still negative with the NYSE bullish percent index and the NASDAQ 100, where the mega caps are. We were starting to see a bounce here below 50. It was still negative, but then in Friday's session, it ticked down. And the reason the Dow is on the negative side of things is because we're below the 50-day moving average. Longer term, we're still positive. The 50 is still above the 200. And the momentum for the NASDAQ 100 continues to be negative as measured by the PPO, percentage price oscillator. And we're below the 50-day moving average with the small caps, even though the longer term trend is still positive. We're just wondering, are these going to be able to kick into gear at some point? We're not seeing this bounce that's automatically supposed to happen. And here's another Russell 2000 small cap index. Below the 50-day moving average, the momentum is negative. And we were getting extreme with the RSI on top, but then it came back down in Friday's session. Still seeing where the small caps continue to underperform the S&P 500. Mid caps also longer term positive, but underneath the 50-day moving average, having a hard time getting back above this pivot point, which is acting as overhead resistance. And this is what's causing a lot of the problems. We're seeing the 10-year yield continue to go up. And that's freaking out the stock market. We need to see rates come back down. That will help stocks. And we're concerned about this too, a ratio from home construction to the 3 to 7 year bonds. We had held up before at the 250 period moving average before and bounced up off of that. We broke through it this time. We were starting to bounce back up, but now we're turning back down. A broad market measure of the 5 period moving average of highs minus lows, we still continue to be below zero. And this is potentially positive, a ZWAG NYSE breadth thrust. We came down, got a really extreme negative reading. We bounced back up. We're back above zero point 0.4, and we are improving. Now, there's a 1 day lag with this chart, so it's probably going to go down when we get Friday's data after Monday. But if within 10 trading days, if we can get up to this red line, that would produce a ZWAG NYSE breadth thrust. You can see other times when it happened, what the S&P did after that. And it can be quite positive. But we don't know if this is actually going to happen. We're just watching to see if it will happen. Then some other areas I'm just keeping an eye on. We want to keep an eye on jobless claims. We're still going up with the moving average, but we saw them decrease with the latest reading. So we're getting a bit of a mixed picture there. Where we are seeing a little more weakness is the continuing claims. So the folks aren't getting laid off, but folks that do get laid off are staying unemployed longer. And we're seeing the moving average going up, and the latest reading also is continuing to go up. And this puts everything together. The continuing claims in blue, the initial claims in red, and then the unemployment rate, which will be updated when we get the employment report in early 2025. And I'm not sure, I put this on the watch list because I've been trying to interpret what this means. And it seems like, okay, I'm obviously getting that wrong here. But we're getting a very high reading with the skew index. This is a variation of the VIX. The VIX uses at the money options to be calculated. This skew index uses out of the money options to be calculated. And when we're up in this red area, the market is expecting some kind of a big move. We're just not quite sure if it's an upward move or downward move. And you can see other times we spiked and finally started to come down. Sometimes that was the top, sometimes it was a bottom, sometimes it was a continuation of what is already happening. And then this is an area just to keep an eye on. This is the spread between risky and not as risky bonds. And we're concerned about interest rates going back up, and that's pressuring the market. And this is still getting a very low reading here. But this is a longer term chart. This next chart inverts the chart. That's the middle area here. And we were starting to really spike up in fear, which means this chart was going down. If this continues to fall, that's going to be more negative. If we can start to go back up, that would be more positive. High leverage loans. And I use this as another barometer of the economy. A lot of folks use copper, and I use that too. And I go over that in the intermarket analysis video. But I keep an eye on this chart too. These are very risky loans. And if the market and the economy was getting ready to fall apart, there are smart people that invest in this ETF. They know what's going on. You can see that we're really looking pretty good here. We're not even back down to the 50-day moving average. And you can go back in time. I've tried to get it a little longer as far as what was happening with the markets here. This is 2022, and this ETF really had some problems. And then it turned positive in late 2022 and has been positive ever since. So you could use this as kind of a proxy for the economy. This is looking good, but I ran across this. This is from Moody's, and this says that leverage loans, like the previous chart we just saw, the defaults are climbing in that ETF. So this is just something to be aware of. We're not seeing it in the chart yet that I just showed you, but we are seeing it here. We want to keep an eye on these things. And then we're keeping an eye on the relationship between cash and 3 to 7 year bonds. This is going up, and that's when the market is uncertain about inflation. The Fed is fearing inflation might be coming back. The bond market is going down in price, up with yields. They're worried about inflation. And the Fed has come out and said they're going to pause cutting interest rates. And so we're seeing this ratio going back up. If that continues to go up, that's going to be a little more negative in the shorter term. But then when we look at TIPS, which are Treasury inflation protected securities, we're still doing okay here. We're going down with this ratio after we had been starting an uptrend. This is meaning that there maybe aren't the big inflation worries. So the jury's still out on this. We look at TIPS and then go further out. Now, this is looking a little more inflationary. So the short term and the long term are worried about inflation. The intermediate term, they don't seem to be as concerned. So that's why I watch these different time frames on these charts. This is going back up and could be causing some problems. Semiconductors, there's a positive side and a negative side, so I just put it on the I'm watching side here. When we look at the SOX index, we're negative. We've seen a recent death cross, and we cannot get back above either the 50 or the 200-day moving average for any length of time. If we can get back above this and eventually turn this to a golden cross, that would be more positive. And we look at a ratio between the semiconductors and the tech sector. This has been really falling off since it was really strong last summer. And now we're just bouncing around here. We have a couple of good days, then we go back down. Then we have a good day, then we go back down. We need this to be convicted to the upside to turn more positive. If we chop sideways or continue to go down, that's going to turn things more negative. And then we look at a ratio between the semiconductors and the Dow, again, another growth area versus a value area. And we're actually not falling apart here, but we are seeing some weakness with this ratio. It would be more positive if this ratio could continue to go up. But then when you look at the ETF for semiconductors, we're doing okay. We're still above the 200-day moving average. We're back to the 50-day moving average. So it depends on what you look at. The first charts were negative. This is not straight out positive, but it's not looking as negative as the other chart. And we're kind of going along here sideways with this particular ETF. We're not really breaking out to the upside of the rainbow, but we're not breaking down right now either. And we just want to keep an eye on the dollar. A stronger dollar pressures stocks. Stocks like a weaker dollar. It's really been going up lately, and that could be pressuring stocks as well. We got up into the 108 range earlier this week. Now we're back into the high 107 range. And then seasonality should be a good time. We've been up almost 80% with the S&P with a return of 3.78%. Unless we have just a couple of rip-roaring days on Monday and Tuesday, we're probably not going to hit that. And this is a historically strong time for the Russell 2000, which are the small caps, but they really haven't been doing anything either. So they've got 2 days left to kind of see if something can improve. And this is the chart finishing out December here, where we typically see positive seasonality for the S&P. But when you go back over the last 21 years, Monday's not looking all that good. But if you take a longer term look, we look better here on this chart. This red dashed line are the small caps, and they should be going to the moon by now, and they've not even been able to get off the launch pad. And then we still have a confirmed Hindenburg omen here. We haven't seen any more recent spikes. We had the initial spike, and then within 20 trading days, we got the other spike. The perma bears love this thing. We want to pay attention to this. Sometimes it gives false signals. The more spikes we see, the more we should pay attention to it, because we saw a whole series of spikes here right before the COVID crash. And then we saw another series of spikes here right at the end of 2021, and then that led into 2022. So we'll pay attention to this, but some of the perma bears that I kind of loosely pay attention to, I mean, they're banking everything on this, but no matter what you tell them, the market's just about ready to fall apart anyway. So we'll try to take a more realistic approach with this. Thank you. I hope you're having a wonderful weekend. Happy New Year to everybody, and I will talk to you in the next video.